Welcome back, and thank you so much for joining me in today's video because I have a really important update to share with you guys. After the Fed announced they're going to keep rates steady at around 5.5% for the federal funds rate, mortgage rates decreased big time. One of the biggest single day decreases in rates we've had on record. So have a look at this. This is according to the Mortgage News Daily as of today, which is Wednesday, December 13th. The average 30-year fix for people with great credit decreased to 6.82%. Look at this, giant decrease of 27 basis points in one single day. A 15-year fix is at 6.29%, jumbo at 7.25%, and FHA and VA loans is around 6.3 to 6.5 or 6.25%. When looking at historical levels here, again, rates right now at 6.82%. The last time we had rates below 7% was months ago. In fact, the rates today are the lowest levels since May 18th this year. So rates decreased to a 7-month low today. Now, before I share why rates decreased so much today, I want to share how this is really impacting current home buyers right now. So if you're a home buyer looking to buy a house right now, this video is for you. So someone looking to buy a $500,000 home, putting 20% down, that would get you the best rate. Back in, what was this, mid-October, so 2 months ago, your average rate was at 8.03%, a 23-year high in rates. Based on this scenario here, your payment of principal and interest, I'm excluding taxes and insurance because I'm only looking at a 2-week span or 2-month span here. So looking at principal and interest or P&I, your payment would be $2,943 per month. Look at this though, when rates decrease to 6.82% based on a $500,000 purchase, your housing payment just decreased to $2,613. This means over the span of just 2 months, you're going to pay approximately $330 less per month because rates have decreased by about 1.2 percentage points. On top of that, because rates have decreased by about 1.2 percentage points, that means your purchasing power just increased by 12%. Additionally, have a look at this, because when rates were at 8.03%, the total amount of interest paid over the life of that 30-year loan would be nearly $660,000. What? $160,000 more than your original purchase price, which is absolutely insane. So $660,000 in interest paid at 8%, but when rates decrease to 6.82%, you're only going to pay about $540,000 in interest paid. This means you're going to pay approximately $120,000 less in interest paid over the life of that 30-year fixed rate loan. So big picture here, for those looking to buy a $500,000 home, putting 20% down, you're going to save around $330 per month because rates have decreased by about 1.2 percentage points. And on top of that, your purchasing power just increased by 12% as well. On top of that, you're going to pay approximately $120,000 less over the next 30 years. So you may be asking yourself, why did rates decrease so much on Wednesday when the Fed announced they're going to keep the federal funds rate steady at 5.5%? It wasn't because the Fed kept rates the same. It was what the Fed said that really decreased rates, and also their forecast for rates over the next 3 years as well. This is according to CNBC. It says the Federal Reserve on Wednesday held its key interest rate steady for the third time in a row here and set the table for multiple cuts to come in 2024 and beyond. So they provided their forecast for what they expect to see the federal funds rate at the end of the year 2024, 2025, as well as 2026. So along with the decision to hold rates steady, the committee by the Fed penciled in at least 3 rate cuts in 2024, assuming a quarter point decrease for each of those cuts. That's less than the market was pricing in for, but more aggressive than what officials had previously indicated. I'll share that here with you guys in a little bit here. Markets had widely anticipated the decision to stay put for the federal funds rate, which could end a cycle that has seen 11 hikes since March of 2022, the highest levels in about 22 years. There was uncertainty, though, about how ambitious the FOMC or the committee here by the Fed might be regarding policy easing. In other words, when will the Fed start to pivot and decrease rates next year and beyond? Following the release of this decision, the Dow Jones jumped by 400 points or more than 400 points, surpassing 37,000 for the first time. This is absolutely wild. The committee's dot plot, this is a measure of the votes by the Fed. They basically asked the members, where do you anticipate the federal funds rate will be at the end of 2024, 2025, as well as 2026? That's called their dot plot. The committee's dot plot of individual members' expectations indicates another 4 cuts in 2025. Keep in mind, the committee members by the Fed were predicting for 3 rate cuts next year, and now 4 cuts in 2025. On top of that, they also are forecasting for 3 more reductions in 2026, which would make the federal funds rate down to between 2 to 2.25%, close to the long run outlook. Also, according to Jerome Powell, who's the Fed's chair, he said inflation has eased from its highs, and this has come without a significant increase in unemployment. That's very good news. On top of that, here's a look at how the statement by the Fed that was announced on Wednesday compares to the previous meeting about 2 months ago. The text here that is striked out is what they said in their previous meeting. Anything in red is what they added for today's statement here. It says, recent indicators suggest that the growth of economic activity has slowed from its strong pace in the third quarter. In their previous meeting, they said recent indicators suggest that economic activity expanded at a strong pace in the third quarter. So this is actually a big change because just 2 months ago, they stated that economic activity was expanding, whereas right now they're saying that it has slowed down in the third quarter. On top of that, they say inflation has eased over the past year, but remains elevated. Their previous statement showed that inflation remains elevated. So they're basically saying here that inflation has been easing, whereas about 2 months ago, they said it still remains elevated here. Here's a look at investing.com's economic calendar here. Here's a look at basically the Fed's dot plot here, but it organized a little bit easier to read here. So their projection for what the federal funds rate will be by the end of 2024, this is the Fed's dot plot. The Fed was forecasting that the federal funds rate would be at 4.6%. In their previous meeting 1 quarter ago, though, they were forecasting at 5.1%. So they're forecasting the federal funds rate will be much lower than was previously forecasted. This means they're anticipating for more rate cuts next year than it was forecasted 2 months ago. On top of that, in 2025, their prediction or their projection is we're going to be at 3.6%, whereas 2 months ago, it was at 3.9%. In 2026, the third year here, their projection is that the federal funds rate will be at 2.9%, same with the last quarter's projection. Now, this is something I want to bring to your attention here because, again, this is for the federal funds rate by the end of 2024 at 4.6%. Again, the previous reading 1 quarter ago was at 5.1%, which is right here. So something that really caught my attention is this right here. So starting in Q2 this year, they saw an increase from 4.3 to 4.6%. Again, the Fed's dot plot during that time frame for the end of 2024. So from Q1 to Q2, they actually were calling that the federal funds rate was going to be higher than was previously forecasted. Then in Q3, another increase as well, going from 4.6 to 5.1%. So this decrease from 5.1 to 4.6% is actually the first decrease since March 22nd this year, or the first quarter this year. So big picture here, what this is telling me is that the Fed is seeing that inflation is starting to wind down here or easing, and therefore they're predicting they're not going to have to keep the federal funds rate at a high level for as long that was previously expected here. And because of that, they are now projecting that we're going to see more rate hikes next year than what they previously thought, because inflation has been winding down more as of late. Now, speaking of that, we also had some more inflation news that was announced on Wednesday as well. And this is called the PPI, or the Producer Price Index. If you guys recall, on Tuesday, we had the Consumer Price Index, or the CPI. That's a measure of inflation at the consumer level, what you and I pay for goods and services on a national level. The PPI is what producers pay. So this is a key measure of inflation that the Fed tracks. This is actually the preferred measure, by the way. So the core PPI excludes volatile energy and food prices. That's a key measure by the Fed in order to determine what direction inflation is headed. So in any case, core PPI compared to October was flat. That's actually better than was forecasted. The forecast was calling for a gain of 0.2%. On top of that, the year-over-year change, this is November last year through November this year, for core PPI was at 2%, which is also better than was forecasted at 2.2%. This is also better than what we saw back in October compared to October last year, where we saw a gain of 2.3%. And lastly, let's have a look at the CME Fed Watch tool to see their forecast for Fed cuts in 2024. So their next meeting by the Fed is scheduled for January 31st. For a 88.6% probability, they're calling for the federal funds rate to be the same at 5.5%. Only small chance of a rate decrease to 5.25%. That would be a 25 basis point rate decrease. Then at our next meeting, scheduled for March 20th, a strong probability of about 75% that the Fed will pivot or decrease rates by 25 basis points. Now, look at this, because this is much different compared to what I said yesterday. Yesterday, which was on Tuesday, December 12th, my mom's birthday, was at 39.7%. That probability of a rate decrease by 25 basis points, now again, it's around 75%. Yesterday, they were calling for a 57% chance for the Fed to keep rates at 5.5%. Now it's a 75% chance they're going to cut rates in their next meeting, or their March meeting. Then in May, they're calling for a 50% chance we're going to be at 5.25%, a 36.9% chance we're going to be at 5%. So by a 37% chance, they're going to call for rates decreasing by 50 basis points compared to today's rates. Then fast forward to their last meeting, which is scheduled for December 18th. They're calling for a 33.4% probability we're going to be at 4%. This means that the street is forecasting that the federal funds rate is going to decrease by 1.5 percentage points, or 150 basis points. So what does this all mean to you and I, especially if you're looking to buy a house? If you're looking to buy a house, or if you have credit card debt, HELOCs, etc., if rates start to decrease, that will cause credit card interest rates, HELOC rates to decrease as well. And of course, mortgage rates to also decrease as well. But again, time will tell, and I'll definitely keep you posted with the latest developments. Please comment below your biggest takeaway from today's video. Also, if you guys got any value out of this video whatsoever, then please hit the like button. I greatly appreciate that. Of course, I appreciate you. Like and subscribe, and I'll see you in the next video. Have an awesome day.